Ever pondered how two economic giants locking horns could shake the world economy? The year 2023 saw precisely that. Escalating tensions between the United States and China. The roots of these tensions are complex and multi-layered, intertwining issues of trade imbalances, intellectual property rights, geopolitical disputes, and human rights concerns. The stage was set years prior, with a trade war that saw both nations imposing tariffs and trade barriers on each other's goods, sparking a climate of distrust and competition. Trade imbalances were a significant point of contention. The United States, with its massive consumer market, had long been grappling with a significant trade deficit with China. On the other hand, China, a global manufacturing powerhouse, was keen on protecting its domestic industries and maintaining a positive trade balance. Intellectual property rights issues further fueled the fire. Accusations flew from the US side, alleging China of engaging in technology theft and forced technology transfers, claims that China vehemently denied. This dispute not only strained the bilateral relationship, but also had broader implications for global innovation and technological advancement. Geopolitical disputes and human rights concerns added yet another layer to the US-China friction. The United States voiced concerns over China's handling of issues in Hong Kong, Xinjiang, and Taiwan, leading to diplomatic spats and further straining their relationship. However, the year 2023 marked an escalation unlike any seen before. The intricate dance between these two superpowers, each vying for global influence and economic supremacy, took a turn. As the year unfolded, the tensions reached new heights, shaking the very foundations of global economic stability. The ripples from the US-China standoff didn't stop at their borders. The global economy felt the tremors too. As the two economic superpowers locked horns, the reverberations were felt far and wide. Financial markets, from Wall Street to the Tokyo Stock Exchange, were hit by waves of uncertainty. Volatility became the order of the day, with investors nervously watching the unfolding drama between Washington and Beijing. The strain of the standoff also seeped into the world's supply chains. As both the US and China imposed retaliatory measures against each other, the intricate web of global trade began to unravel. Businesses found themselves caught in the crossfire, grappling with bottlenecks, delays, and the daunting task of restructuring their sourcing strategies. The ripple effect was felt by industries worldwide, from electronics to automobiles, and even agriculture. This economic tug-of-war also cast a long shadow over the business landscape. Companies, big and small, faced the daunting prospect of increased tariffs, regulatory hurdles, and the unpredictable whims of geopolitical risks. The balance sheets of multinational corporations were under immense pressure as they had to navigate the treacherous waters of the US-China tensions. But it wasn't just the boardrooms that felt the heat. The standoff also trickled down to the everyday lives of consumers. As the tensions escalated, the confidence of the global consumer took a hit. Spending patterns fluctuated, with people holding off on major purchases, uncertain of what the future held. Investment decisions were put on hold as the world waited with bated breath, hoping for a resolution to the standoff. Yet amidst the turbulence, there were also lessons to be learned. The world saw firsthand the interconnectedness of our global economy. The standoff served as a stark reminder that in this era of globalization, no nation is an island. The decisions made in Washington and Beijing echoed across the world, impacting economies from London to Sydney and Buenos Aires to Tokyo. In the vast web of the global economy, no nation could hide from the effects of this standoff. As we move forward, it becomes crucial for nations to navigate these complex dynamics with care, understanding that our economic fates are intertwined now more than ever. Then, one of the most glaring challenges of the US-China tensions was the disruption of global supply chains. This disruption wasn't merely a bump in the road, but a seismic shift that shook industries to their core. Industries that had long relied on the smooth functioning of cross-border trade found themselves in a precarious position. Imagine a domino setup. Once one piece falls, the rest follow suit. This was the situation for industries worldwide. The automotive sector, electronics, textiles, and countless others found themselves grappling with bottlenecks and delays. Companies that had spent decades building efficient, cost-effective supply chains were now staring down the barrel of a logistical nightmare. The solution: diversification. Much like an investor spreads their risk across various stocks, companies began to diversify their sourcing strategies. They explored alternative production locations, sought out new suppliers, and rethought their entire operational blueprint. This was not a simple task. It was akin to turning a cruise ship. It takes time, careful planning, and a lot of space. However, this restructuring wasn't just a protective measure. It was a necessity for resilience. In an increasingly interconnected world, dependency on a single source is a risk too great. The diversification of supply chains ensured that should one link break, the entire chain wouldn't crumble. Yet, this shift was not without its tribulations. The short-term costs were substantial. Companies had to invest in new facilities, train new workers, and navigate unfamiliar regulatory landscapes. Then, there were the logistical complexities. Coordinating a global supply chain is like conducting an orchestra. Every instrument must play its part at the right time for the symphony to come together. Recreating this harmony in a new setting was no small feat. The restructuring of supply chains, while necessary for resilience, came with its fair share of tribulations. But as they say, necessity is the mother of invention. In the face of adversity, companies were forced to innovate, adapt, and evolve. And perhaps, in this lies the silver lining of the US-China economic tensions of 2023. At the core of the US-China tensions lay an intense race, the race for technological supremacy. This was not just a battle of hardware and software, but a struggle for strategic advantage, shaping the future of global innovation, economic power, and national security. In this high-stakes contest, both nations vied for leadership in emerging technologies. Artificial intelligence, fifth-generation wireless networks, quantum computing, these were the new frontiers. Each held the promise of transformative impact, changing the way we work, live, and interact. Yet they also presented significant challenges, particularly in the realm of cybersecurity and data privacy. The United States and China, each with its own strengths and vulnerabilities, grappled with these issues. For the US, with its robust tech sector and culture of innovation, the concerns centered around safeguarding intellectual property and managing the risks of technological espionage. China, on the other hand, with its vast digital economy and ambitious tech-driven development plans, faced accusations of data misuse and intrusive surveillance. The tension was palpable in the tech industry. Companies operating in both markets found themselves navigating a complex web of regulatory hurdles and investment restrictions. The very fabric of the global technology ecosystem seemed at risk of fragmenting as efforts to decouple the two tech sectors gained momentum. This not only threatened the free flow of ideas and collaboration, but also raised the prospect of a balkanized internet, divided along geopolitical lines. Yet, amidst the rivalry, there were also opportunities for cooperation. Shared challenges such as cybersecurity threats and the ethical use of AI called for collective action. The global nature of these issues underscored the importance of setting common standards and norms, a task that required leadership from both the US and China. The quest for technological dominance added a new dimension to the already complex US-China relationship. The outcome of this race could not only determine the balance of power between these two nations, but also shape the trajectory of the global digital economy for decades to come. The US-China standoff didn't just stir economic waters, it reshaped geopolitical landscapes too. The intensifying rivalry exerted pressure on countries worldwide, forcing them into a precarious balancing act. Unprecedented challenges emerged as nations found themselves caught in the crossfire, having to navigate the stormy waters between these two superpowers. The ripple effects of this standoff were far-reaching, extending beyond economic boundaries and into the realm of geopolitics. Regional flashpoints added fuel to the fire, particularly territorial disputes in the South China Sea and diplomatic tensions over Taiwan. These contentious issues threatened to escalate the economic rivalry into military confrontation, raising the stakes even higher. But it wasn't just about avoiding conflict. It was also about finding a way to thrive amidst the shifting sands. Nations had to adapt to this new world order, recalibrating their alliances and adjusting their strategies to maintain stability and prosperity. The year 2023 saw the world map redrawn, with alliances and power dynamics shifting under the weight of US-China tensions. It was a year of change, a year of adaptation, and above all, a year that marked a new chapter in global geopolitics. Despite the turbulence of 2023, hope remains for easing US-China tensions through constructive dialogue and pragmatic solutions. Navigating the storm requires keeping the lines of communication open, a commitment to engaging in diplomatic discourse even in the face of adversity. It's about finding areas of mutual interest, climate change, public health, global security, to foster cooperation and build bridges. Equally important is the pursuit of fair and reciprocal trade agreements. The goal should be to address the concerns that have contributed to the tensions, from market access and intellectual property protection to state subsidies. It's about negotiating in good faith, recognizing that a win-win scenario is not only possible but also beneficial to both nations and the world at large. The storm of 2023 may have passed, but its lessons remain. It's a call for greater cooperation and understanding in the intricate dance of global economics.